Is Bitcoin oversold? It seems to be, and history says the time to buy is now. This is not financial advice in the slightest, and before we get into any indicators or fancy charts, I want to anchor everyone on one simple fact: where we are today. Bitcoin is trading in the mid 60,000s right now, but we need to zoom out. The last major peak in the data set of Bitcoin between 2018 and 2026 was back in October. We hit the all-time high of $126,000. And then in this month of February 2026, we did print a local low around 63,000, so around peak to bottom. That's basically a 50% drop. And I want to pause here because for people who are newer to Bitcoin, a 50% drop feels like the end of the world. In traditional investing, if an index drops 50%, it usually means that something is broken or the economy is in a worldwide crisis, but Bitcoin acts differently. Bitcoin is a high volatility asset, which means that it moves faster and more violently than stocks. It overshoots on the way up and it overshoots on the way down. That volatility is not a glitch. It really is the normal operating environment for the asset. So the question is not, wow, it dropped 50%, is Bitcoin dead? The real question, historically, that we are going to be answering today with rigorous statistical analysis: when Bitcoin falls this much from the peak, what tends to happen over the long run? Because if you're thinking like a long-term investor, the best entries often feel terrible in the moment. They feel like you're catching a falling knife. They feel like buying something that everybody else hates. And this slide is simply establishing that we are in one of those moments right now. We are sitting in a zone that Bitcoin has visited many, many times before, a deep correction zone. And in the next slides, I am going to quantify what that has historically meant for future returns. We're not trying to predict tomorrow's price here. We are measuring whether the current setup has historically been a high probability, high upside entry zone for long-term investors, even if the short term remains very volatile. All right, now that we have anchored where we are right now, I want to introduce a tool that helps us measure something very simple: how overheated or how exhausted a market is. The tool is called the RSI, which stands for the Relative Strength Index. Here is the most normal person way to understand RSI. RSI is basically a speedometer for price movement. It doesn't tell you what a Bitcoin is worth. It tells you whether the price has been moving up too hard for too long or down too hard for too long, and it runs from 0 to 100. So when RSI is high, like 70 or above, it usually means that the market is running hot, lots of green days, lots of optimism, sometimes even euphoria. But when RSI is low, like 30 or below, it usually means that the market's been getting hit, lots of red days instead of green days, lots of fear, the sellers pushing hard, people giving up. Now, here is the key point. All of this analysis in this video is from the Bitcoin price action from 2018 to today. I did want to ignore the crazy outsized returns that Bitcoin had in the early days. And in addition to the daily RSI, we're also going to be looking at the weekly RSI as well, because the daily tells us what's happening in the very short-term mood swings, but the weekly RSI really tells us something closer to the emotional state of the whole cycle that we're in. It's basically the difference between a bad week and a full-blown collapse in confidence. So right now in the data, the daily RSI for Bitcoin is in the low 30s, which is already considered oversold, but weekly RSI is even more dramatic. It's up in the high 20s, which is rare, and it usually shows up when markets are in capitulation mode. Capitulation is just a fancy word for the moment that a lot of people stop thinking rationally and start hitting the sell button because they can't take the pain anymore, and that's why this matters. When the weekly RSI gets this low, it tends to happen near the kinds of turning points where the market is very deeply washed out. Now, very important disclaimer, this does not mark the bottom because Bitcoin can stay oversold longer than some people expect. It can bounce, then it can dump again, it can chop around for months. So we're not using the relative strength index as a crystal ball. I am using it as more of a stress gauge. And what this gauge is telling us right now is that the market is not in a happy bull run state at all. It's in a people are exhausted, the fear is thick, and selling has been intense state. And historically, when you combined with this kind of washed out momentum with the deep drawdown that we just covered on the last slide, you are often looking at a zone that has produced very strong long-term outcomes, even if the short term is still messy. So to recap, RSI is telling us that we're in an extremely emotional environment right now, and historically, emotionally extreme environments tend to create mispricings, which creates opportunity for long-term investors. The last time the RSI was this slow was in the crypto winter of 2022. And I want to tell you a quick anecdote. If you guys didn't know this, the S&P 500 has outperformed Bitcoin by over 4x over the last 5 years. If you go back 5 years, February of 2021, and you started then, went to today, you will have seen that the S&P 500 has greatly outperformed Bitcoin. However, we know that most people didn't smash by the S&P 500 on that day, and then they sold it today. So really, you need to be thinking about dollar cost averaging, because people invest little by little throughout time. Now, because the Bitcoin dollar cost average people, they were buying when the RSI was low in 2022 during that crypto winter, if you would have DCA'd into Bitcoin instead of the S&P 500, you still would have greatly outperformed the S&P 500, even though the Bitcoin cumulative return gain is a lot lower than the S&P 500 over that time horizon. So what is the point I'm making? I'm just saying the last time the RSI was flashing this level of oversold, it was a great idea to buy Bitcoin. So that slide was about momentum and emotional exhaustion. Now I want to get into something even more simpler, how far the price has drifted away from its long-term normal level. The main tool that people use here is the 200-day moving average. This is the normie version. I'll explain it to you. A moving average is basically just an average price over a window of time. The 200-day moving average takes the last 200 days and it basically smooths it into one line. So why do people care about the 200-day average? Because it's one of the best simple proxies for the long-term trend of the asset. When the price is above it, the market is usually healthier. When the price is below it, the market is usually under stress. Now, what's special right now is not that Bitcoin is just below the 200-day average. It is far below the 200-day average. If we look to the data, the 200-day average is around $100,000, 99.6K. And the price is still in the mid-60,000s. That means that Bitcoin is roughly 1/3 below its long-term trend line. And that's a big deal because markets don't live that far below their trend line for long unless something is breaking or unless fear has gotten extreme. And this is the key idea, folks. Markets tend to swing like a pendulum. You know that in bull markets, the price runs far above its long-term average and people get excited. Then they overpay for the asset and then it stretches upwards. But in bear markets, price often falls below its long-term average. People panic, they underpay, and it stretches downward. So this slide is showing that we're not just below the trend, we are stretched far below it, and we can quantify that stretch. In statistics, folks, we really measure how unusual something is by looking at how many standard deviations away it is from its average. You can think of standard deviation as a measure of what's normal movement versus what is extreme movement. And right now, Bitcoin is more than 2 standard deviations below its 200-day average right here. So in plain English, that means that this is not some normal little dip. This is an extreme downside extension, the kind that you see during capitulation, major shakeouts, or ugly parts of a cycle because FTX collapsed. Now, again, the disclaimer, this does not mean that it can't go lower. It just means that we are in the zone where the market is statistically stretched, especially when we look at the data over the last 8+ years. And when markets get stretched, one of two things tends to happen over time. Either they revert back toward the average, meaning that the price eventually recovers toward that long-term trend line, which in Bitcoin's history, it always does that and then some, or the asset enters a completely different structural regime. Bitcoin has historically reverted violently, repeatedly. That's why this matters for the long-term bull case. Because if Bitcoin's long-term trend remains intact, then this being this far below trend has historically been the kind of moment where the long-term buyers get paid. Not immediately, not comfortably, but over time. All right, up to now, we have talked about two types of evidence. First, we looked at momentum, the relative strength index, and then we looked at the 200-day moving average. But now we need to answer a question that a lot of people like to ask with Bitcoin, especially the people who want to allocate to it but haven't yet. They've seen the outperformance over time, but they do get a bit scared of the volatility. The question is, even if Bitcoin goes up over time, is it worth the risk? Because Bitcoin is extremely volatile, we know it's a roller coaster. So how do we evaluate that trade-off in a clean statistical way? This is where the Sharpe ratio comes in. Here's the simplest explanation. The Sharpe ratio measures how much return you got for each unit of volatility that you had to endure. So it's not, did it go up? It's how efficiently did it go up relative to how wild the ride was. A higher Sharpe means a better deal, more reward per unit of chaos, and a lower Sharpe means that you took a lot of chaos for not much reward or even negative reward. So this is the key point for this slide. When you look at Bitcoin across long periods, it has produced a positive Sharpe ratio because of its amazing outperformance. That means that over the long run, the reward has been large enough to justify the volatility for investors who can hold through the volatility cycles. But when you zoom into short periods of time during a drawdown, the Sharpe ratio turns negative, and this is yet another indicator of a bear market, which would mean a good time to buy if you're investing for the long term. So in my data set over the last 8 years, what I found, obviously that Bitcoin's Sharpe ratio was positive, but over the last year, actually, not even the last 3 months, 6 months, over the last year, it's negative. And over the last 90 days, more interestingly, it's even more negative. Now that sounds bearish until you realize what you're actually describing. It's describing the current regime. It's describing the current emotional pain that we're living through. So in plain English, Sharpe is basically saying, yes, recent returns have been bad and the ride has been rough. Correct. Yes. We can all feel that. But this is why this slide still supports the long-term bull case, because the very periods that produce the worst short-term Sharpe ratios, the worst recent performance per unit of pain, are often the same periods that set up the best forward returns, because markets tend to overreact in both directions. So I'm not here to say Bitcoin is safe necessarily. Remember, I'm not giving financial advice. I'm giving financial entertainment. Bitcoin is here to say Bitcoin's long-run risk-adjusted returns have historically been strong, but it comes in regimes. And ironically, those terrible-looking regimes are often where the long-term investors build positions that always look genius later. All right, now this is the fun part of the video, the part where I stop using vibes and start using the most important question that we're going to ask today. When Bitcoin is down this much from its all-time high, what has historically happened next? Because most people, they look at a chart and they either panic or they cope or they argue on the internet, but we're doing something different today. We're going to be taking every single day from 2018 to today, and I'm going to group it by how deep Bitcoin was below its prior peak on that day. And then I'm going to ask a very simple question. From that day, what were the returns 1 year later? And what were the returns 2 years later? That's it. No stories, no narratives, just conditional probabilities here, statistical analysis that I have done for you. Now, what do the bears do? The bears look at the price action, they see a red candle, and then they think it's going down forever, but it's not based on math, it's based on vibes. What I'm trying to do is I'm trying to assign a statistical probability based on historical Bitcoin price action, what to expect in the future. Now, is past performance indicative of future results? That can be always debated, of course, but the reality is Bitcoin has greatly performed in history, and the bears are ignoring that to look into their crystal ball to make a prediction that it goes to zero. Which side would you rather be on? So here's the baseline. If you bought Bitcoin on a random day between 2018 and today, and you look 1 year later, the median outcome was around plus 50%, plus 52% to be precise. And the chance of being up on your position was around 70%. Now that is already a strong asset, but this is where it gets interesting. When you only look at the days where Bitcoin was already in a deep drawdown, say 45% or more from the all-time high, the forward outcomes improve dramatically. The median 1 year return from a 45% Bitcoin drawdown is 85%. That's correct. We have drawn down more than 45%, and the median 1 year return from drawdowns of that size are 85%, the probability of being up 1 year later goes from that 70% to 87.6%. Now, if we tighten it even more, when you look at the days where Bitcoin was down 50% or more from the all-time high, like the zone that we're in now, the probability of being up 1 year later rises to just under 92%. That's a huge shift in the odds here. It doesn't mean that every time is a win. It just means that the distribution moves. So what I'm saying is that when you buy during these drawdowns, the probabilities tilt in your favor historically. Now, if you take the same idea and then you extend the horizon to 2 years, when the entry day was down 50% or more from the all-time high, the median 2-year return from this data set was plus 295%, a 3.95x, and the probability of your position being positive was 97.2%. That is almost 4x the median outcome here. So this is the core statistical bull case in one sentence. Deep drawdowns are where Bitcoin has historically offered the best long horizon return distributions, because that's where the panic compresses the price below the trend, then the momentum washes out and forward expectancy rises. Now, one more time, this is not a guarantee. This is not a promise. This is simply what the data has said historically, and it gives us a rational, quantified way to say why a moment that feels scary can also be the moments with the best long-term odds. When Bitcoin is down 45 to 50% from its peak, the historical probability weighted outcomes over the next 1 to 2 years have been meaningfully better than average. What the data says is that this is historically a very high expected value zone over long horizons, and the path does matter, because Bitcoin is famous for making the path as psychologically unpleasant as possible, especially if you're not totally orange-pilled yet. This is why I'm still bullish on the apex asset. I love Bitcoin. That's why I preach the orange gospel to you guys every single day. If you want to enjoy more preaching of the orange gospel, please like this video and subscribe to Swan, where we bring you the daily Bitcoin insights with more energy than anybody. Have a terrific day, everybody. Do not party too hard. Class dismissed.